Ladies and gentlemen, thanks for attending this webinar. On behalf of the Financial Forum, I would like to welcome all of you to this webinar about the new profile of risks for banks and the financial sector. The moment to host this webinar could hardly have fallen better. If the banking sector was still in a state of grace at the beginning of March, it has since had a rude awakening. A mini banking crisis brought back memories of the September days of 2008. What is going on? Banks have undergone fundamental transformations in recent years. After the global financial crisis, risk management was strengthened and capital and liquidity buffers were significantly increased. Financial institutions led the way in the use of new technologies and digitalization and were contributing to the transition to a sustainable, more green economy. Those transformations were accompanied by additional risks and had to be managed in a financially challenging environment of prolonged low or even negative interest rate. All this worked out quite well. But meanwhile, global monetary policy struck out in a different direction to combat high inflation. That sharp turnaround was apparently not without consequences for financial stability. And while the immediate danger seems to have passed, it continues to smolder under the surface. Last weekend, another local but not small bank had to be rescued in the US, and the unrest does not seem to have completely disappeared. How is it that a regional bank in the US, Silicon Valley Bank, with which European banks were neither exposed nor interconnected, rocked the banking sector worldwide? And how does the European banking sector position itself in all this? Do we have the feeling that after the Credit Suisse case, why we do have the feeling that after the Credit Suisse case, there is relative calm among European banks, economy in soft recovery mode, interest rates gradually rising, which is rather positive for banks, and no significant materialization of losses so far, but no one is completely at ease. And what does this all mean for the institutions themselves, but also for regulators and supervisors? What lessons can be drawn from the events of recent weeks? Which direction should it go? Can the reports from US regulators, the Fed and FDIC, provide inspiration also for the European context? Many questions for uncertain times. But fortunately, we have top specialists on hand who can help show us the way. We are particularly pleased that the chairperson of the EBA, Mr. José Manuel Campa, has agreed to give his views on the current state of the banking sector and its challenges. This is obviously a special honor, and we are extremely grateful to him. Afterwards, Professor Georges Hübner, well known to this audience, will present his views on the challenges for the financial sector and its implications. Let me first of all briefly introduce Mr. José Manuel Campa, the chairperson of the European Banking Authority. I will be short, as José Manuel has an impressive CV in academia, public and private sector. José Manuel holds a PhD and master degree in economics from Harvard University. He was professor, among others, at the Stern School of Business of New York University and at Columbia University. He was consultant for a large number of international organizations, served between 2009 and 2011 as Secretary of State for the Economy in Spain, and was member of the Liikanen Expert Group on Structural Reforms in 2012. He served between 2015 and before joining the EBA as Global Head of Regulatory Affairs for Group Santander. And since May 2019, he is the chairperson of the EBA. After José Manuel's presentation, as said, Professor Georges Hübner will present his perspective. Professor Hübner is a well-known and highly respected professor of finance of University of Liège. Professor Hübner was appointed in 2009 by the Belgian Parliament as an expert for the Commission in charge of analyzing the Belgian aspects of the financial and banking crisis, and again in 2011 for the Commission in charge of analyzing the collapse of Dexia Group. Professor Hübner has numerous publications and awards on credit risk, hedge funds, and portfolio management. He is visiting professor in various universities, is non-executive director of Belfius Bank, chairman of the audit committee, and member of the risk committee. We will start with José Manuel Campa before giving the floor to George Hübner. The audience can ask questions through the chat function, and we will submit a selection of these questions to the speakers. But as promised, we will close no later than 2:15. So hi, it's time to start. Dear friend José Manuel, the floor is yours.
Well, thank you very much, Joe, for this introduction. Good afternoon to everybody, and thank you for the Financial Forum for inviting me to participate in this discussion today. It's a real pleasure to be with all of you. As you indicated in the introduction, Joe, these are uncertain times. I'm not sure if they're difficult yet, but they're certainly uncertain, and hopefully they will not become more difficult as we go forward. You know, I would like to go through a quick summary of a presentation of how we see the European banking sector right now. How do we see that it's navigating these challenges, as I put in the title of the presentation for today, and also particularly focus a little bit in some of the key issues that have been arising over the last 2 or 2 months, resulting in some important, as you mentioned, resolution cases and crisis situations, both in the United States and in Switzerland. If I may go to the next slide, please. Very quickly, and I don't want to make a summary of the macro environment in which we're operating, but I think that the volatility across financial markets over the last 3 months has been the key or the word, particularly for the banking sector overall. I think that volatility is been arising as a result of a broader macro environment in which we are moving from a long period of low interest rates into a period of higher interest rates, positive, of course, but also higher. And that transition is taking place, I think, across most developed economies around the world, but somewhat at different speeds. Yesterday we saw an announcement from the Fed increasing rates once again. Today the ECB is concentrating on a similar decision. We'll know the outcome this afternoon. But I think it's fair to say that the transition that we have experienced over the last 18 months it's been very significant, and it's been coupled, if I may, with 2 other major trends. One is that we're coming out of COVID after 2 periods of the economy being in basically intervened mode, and normalization of those policies and on some of the scars that the COVID period may have left in the corporate and in the household sector is still pending, while at the same time we jump into a geopolitical tension and a war in Europe that had serious implications also for economic activity and particularly for relative prices with differential effects in different sectors of the economy. So those 3 things are coupled together, you know, back to normal or somewhat back to normal from 2 years of exceptional COVID-related economic activity, a large geopolitical shock, and inflation that has led to an increase in rates very large. And all those 3 are being digested by economic activity and obviously by financial sectors, and as it cannot be otherwise, these large forces have an impact on banks and their current situation, also more important probably their future outlook. If I might go to the next slide, please.
Ali.
Next slide, please. Thank you. So a quick summary of this, of the status quo, the situation of the EU banking sector right now in the European Union and what has been happening over the last years. What I would call the balance sheet situation of the banks is relatively comfortable. You know, in terms of capital, the average core equity tier 1 capital at the end of last year it was on the range of 15.3%, almost very close to the highest ever reported, certainly much larger than we had in the global financial crisis a bit more than a decade ago. Since people are referring to analogs to that period, it's important to keep that in mind. There's a substantial difference. And I will say, not only there's more capital, sometimes we forget it's also more capital of better quality. There's been a lot of regulatory reforms on the definition of capital, on the calculation of capital, and as well as the calculation of other loss absorbency instruments that are in the balance sheets of the banks beyond core equity tier 1 capital. So there's also AT1, there are MREL eligible liabilities. So it's a lot of progress that has been put forward in terms of solvency. More important also as well, profitability has improved substantially over the last year. Joe mentioned that the increase in interest rates has been positive for banks over the short term. Certainly it has been positive in terms of profitability, and we see a return on equity that reached 8% in 2022, which was a number that we had not seen in the past for many years. So that's a really good outcome in that sense. As Joe mentioned, the increase in net interest income has been the main contributor to that rise in profitability, and that's been a good development. Now, beyond profitability, and I'll come back to this later on in my presentation, liquidity is also ample. The liquidity coverage ratio, which is the regulatory ratio for short-term liquidity that we assess, it's over 160% in the European Union banks for a regulatory number of 100%. So that's also very, very good. That has remained at very high levels ever since the COVID crisis has started over the last 3 years. So that's really, really good. Third, in terms of asset quality, again, I'll come back a little to the presentation, but the quick summary, asset quality has also been good, and actually NPL ratios have not risen yet as we go through the evolution of this difficult period that I say we have been living over the last 18 months. If I may go to the next slide, please. One, obviously, impact of the high interest rates that I'd like to discuss and highlight is that it has an impact on lending, on demand and supply, and I will call this the intended consequences of rising interest rates. Loan growth has stopped in the last quarter of last year. Banks report lower standard volumes of loans, both in household lenders and corporates. Higher rates are also being passed on to borrowers, so lower consumer and business confidence and higher net prices has also impacted that. And as we see that, when we look at the ECB bank lending service, the euro area banks are reporting a substantial tightening on credit standards for loans and credit lines to enterprises, both throughout last year and also in the first quarter of this year. Some people say that maybe that increase in number of tightening may be plateauing. But at the same time, as I said, this is intended consequences of the increase in interest rates as part of the tightening of monetary policies to expect that financing conditions will become more harsh, and that's being trickled down throughout the economy. Now, if I move on to the next slide, here you have the pockets of risk that have started surfacing credit. As I mentioned before, on the top left-hand side chart, you see the evolution of the non-performing loan ratio and the volumes across the union. There's been a long-term trend since the last decade for improvements of that measure. The long-term trend, of course, partially has been from an exceptional program that was multi-year, that was put forward for European banks to try to decrease the stock of NPLs. That has worked, and actually that continues to work, if I may, because part of the reason why the overall NPL ratio for the European Union banks continues to decrease is because in some of the banks, in which there still is a large legacy of NPLs, they've been continuing to manage those proactively. They've been selling them. They've been decreasing the presence on their balance sheet, and that has contributed to the overall decline. Now, at the same time, if I may, on the bottom left, we see some early indicators, we call early indicators of potential deterioration on credit quality. What you see there is the evolution of stage 2 volumes. Stage 2, as you know, is the previous stage and the IFRS 9 to stage 3, so it's an early indicator of non-performing loan activity. And the stage 2 loans have increased, over the last few years. They've been increasing since COVID, and the composition of those stage 2 loans have been shifting over the last year a little bit. Some of the firms that were put under stage 2 as a result of COVID, as the situation normalized, they moved out of stage 2 and back into better credit quality, while at the same time, some sectors that were more hit because of the war and the direct impacts of the war on the Ukraine, firms in those sectors have been moved into stage 2, but the overall flows still have been relatively stable over the last year, but also at the same time, I must say, relatively high relative to previous years. Now, if we move on to the next slide, please. Here, I'd like to focus a little bit more on some areas when we think about, where do we see potential deteriorations of credit quality going forward. We usually tend to think about 2 key aspects, or 3, if I may. First, those areas where loan growth has grown a lot in the past, so there may be potential excess that may need to be digested. The second one is where leverage is high. That's always a single aspect. And the third obvious point is to think about where, particularly in the real estate sector, where there's more volatility and more cyclicality. And that brings us to the commercial real estate, as particularly vulnerable to higher interest rates. So loans to commercial interest rates, to commercial real estate had increased, and it's a significant part of the portfolio of the banks. The average NPL ratio is too much higher than the average NPL ratio for the overall loan book of the banks, and the stage 2 allocation, you can see there is significantly higher, 16%. Although it's being improved slowly in the short term. Now, as you know, and here I don't have the information, but just to give you a reference, this also has been a key area of focus over the last 2 months in some of the regional banks in the United States, which have large exposures to commercial real estate in the United States, and there's the perception there that there's a structural, beyond the cyclical evolution of the real estate market, there's also a structural shift on the business model for many of these commercial real estate, particularly office space, and that's being put under a lot of pressure. So for us, that's an area of focus and of attention going forward. As I said, so far, the contention, the degree of credit deterioration seems to be contained, but nevertheless will continue to be an area of focus going forward. If I may go to the next slide. A second key area of focus that has been very much highlighted as a result of the intervention and the resolution on Silicon Valley Bank is the evolution of potential issues of debt securities held at amortized cost. I'll come back to this issue in the next slide with a broader approach, but in general, it's reasonable that as interest rates go up, we know that interest rates go up tend to mean usually that fixed income securities lose value. As you know, banks hold fixed income securities with different accounting methods. You'll see that on the bottom chart, the composition of the portfolios of banks' fixed income securities, whether they're being held at amortized cost, at fair value, or at market value. The evolution of this portfolio has been increased, particularly the percentage at amortized cost over the last few years. Now, the debt securities held in the EU balance sheets represent 11.6% of total assets. There's a higher prevalence of these securities in the portfolio of mid to small size banks, as you can see in the top left chart of the slide here. The size of this portfolio, coming back to the issue of the Silicon Valley Bank in the EU banks, is slightly smaller than the size of this portfolio on the US banks. Additionally, what we call the unrealized losses, but on those parts of the portfolios that are not at market value, are less material for EU banks as they have been for the US. But more important, what I would like to highlight is the extreme business models such as Silicon Valley Bank, thinking about their asset side of the balance sheet, in which they have mainly fixed income portfolios with long durations. That such of an extreme composition of a business model is not prevalent in any significant EU banks, and we've been sort of trying to assess this carefully with supervisors, and at this stage, that's our assessment that such an extreme model does not appear to be in EU banks. Nevertheless, this continues to be an area of focus and attention. If I may go forward to the next slide, what you see here is a bit broader than just the assessment of the fixed income the fixed income portfolios of banks, because of course banks hold fixed income securities many times for different purposes, and one of the key purposes for which they hold those fixed income securities is to manage their overall interest rate risk on their book, on their banking book. So part of it may be as a hedging strategy. of the other positions they might have in their loans on the assets or on the liability side of their overall balance sheet. And here what you see is the assessment of what we call the interest rate risk on the banking book of the banks. And basically when we do the assessment from the regulatory point of view, we do two types of assessments. We see what is the impact of a shock of interest rates, a change of interest rates, an increase, a decrease. I'll come back to the type of shock in a minute. In the yield curve on the net interest income of banks. We already discussed that earlier on. Both Joe and I highlighted that in the short term, the net interest income of banks has increased in the European banks, but more important, what we call on the EVE, on the enterprise value of equity, which is basically on the overall balance sheet of the banks and potential impact that the change in interest rate will have not just on the P&L, but also on the composition and of the loan and liability portfolio of the banks. For that, as the regulators, we have a test, and we've been doing a strong surveillance of this aspect for over a year now. This was an area that we put as a focus as we saw that the interest rate environment was changing. We also put forward regulatory products on how to do this assessment. And what you see on the bottom left chart there is the impact of the economic value of equity of a net interest income, the two measures that I highlighted, of a 200 basis points parallel up shocking scenario of the yield curve. Where we basically assess this is a standard supervisory test that we ask banks to do. They say what will happen to your net interest income and the enterprise value of your equity if the yield curve were to move up by 200 basis points. Now, as you see on the left, on the bottom right-hand side, the yield curve in Europe actually has moved already by more than that over the last year, and in the US has moved by substantially more than that. So this shock, that this scenario that in normal cases may seem to be robust or quite exceptional, actually has been in some cases, in this case, surpassed by reality. But nevertheless, what you see there is that the impact is quite limited. When I think about enterprise value of equity, it's a 10% decline. So the way to read that is basically, the way we read that is the impact of the overall shock on interest rates at 200 basis points. It has a 10% impact on capital. Now, the top left chart will show you there is what will be the impact, again, on the two variables, net interest income and enterprise value of equity, of different shocks to the interest rate environment. Where it's, I highlighted before, a 200 basis points parallel shift up of interest rates, but of course the interest rates can go down. The yield curve can change its slopes, can become steeper, can become downward sloping. So you see just the different impacts of there. Usually, actually, this analysis was usually down to try to, in general, assess what would be the impact of a parallel down, of a general drop of interest rates, because it tends to be the ones that's more to which banks are more vulnerable. You see that on the more right-hand side, two columns of the top left chart, where you see that the negative impact on the enterprise value equity is actually quite large for the number of banks. What that's the case, but of course we will see the rise on interest rates. I may mention here, that we are now in the middle of our stress test exercise for the European banks, which will be publishing the results at the end of July. This is a stress test that we run over 70 banks, which represent 75% of the EU banks. And what I'd like to highlight is that the adverse scenario of that stress test precisely very much focused on the analysis that we're going through now, where we'll have an adverse scenario that has the macro environment providing higher and more persistent inflation, which implies higher and more persistent interest rates that filter down into a lower economic activity that implies higher unemployment into the economy over the 3-year horizon, and as a result also significant adjustment in asset prices, both in equity prices and real estate prices. That's the scenario towards we are testing the banks this time, and I think that's actually quite relevant for the experiences that we're going through right now. And I think that exercise, which, as I said, we will publish the results at the end of July, will help provide more input in how banks will perform going forward, likely to perform going forward. Now, if I may move on to the next slide, sorry. And now I'm going to shift from more the analysis that we've been doing so far, more focus on solvency, to talk a little bit about liquidity. The bank's liquidity position has remained very strong. I said that at the, earlier on when I was talking about the overall status of the banks. But of course, as I put in the title of this slide, there's no room for complacency. The top left chart shows that deposit inflows continue to be positive, but of a much smaller amount than they used to be in the banking sector. The liquid assets held by banks as a result as a percentage of total assets, as you can see in the right-hand side of the chart, is very large. But the reason why we said there's no room for complacency, if I may, there's threefold. The first one has to do with the normalization of monetary policy. We do see that banks will have to return a lot of the borrowing that they have done from the central banks, and the return of the TLTRO, in particular in Europe, will be substantial. It's been substantial, so that's one obviously drain of liquidity in the system. Second one is the increase in interest rate, the overall standard monetary policy that makes interest rates, so therefore funding, potentially more expensive for banks. And third, if I may, also the experience from the recent turmoil, particularly the US banks, in which we have seen a large amount of very quick and very large withdrawal of deposits in banks, in certain banks, once there is certain concerns about their potential viability or medium or long-term business model assessment. So in that context, if I may move on to the next slide, here you have the composition of the mix of funding of banks, of liquidity fundings. And here again, coming back to what I highlighted, the experience from the recent experience from the US Bank, I also would like to mention just a couple of numbers that you see in the first bullet point that the report from the Fed last Friday highlighted. Silicon Valley Bank lost 42 billion of deposits within a day and was expected to lose another 100 billion the next they were to remain operating in its the status quo at the time. That will amount for about 80% of total bank's deposits. That's about 10 times more than in the previous largest run in the EU bank, in the US banks, which was in 2008, and 10 times faster. Because the amount of deposits that were withdrawn previously were much smaller over the period of a week. So that the present speed of deposits, that we have seen repeatedly in some US regional banks, also in the case of Credit Suisse. This is an episode that we have not seen in the European banks over the last 2 months. In that sense, there has not been contagion in that far, with one exceptional episode, which was right after the Credit Suisse event. The week after there was amount of pressure in some large banks in Europe, particularly Investment Bank and particularly Deutsche Bank, which reported that they had last week. The report they had over that quarter 40 billion of withdrawal of deposit. But in general, we have not seen anything similar to what has happened in the US regional banks in terms of deposit withdrawals. Nevertheless, what you can see there, the diversified mix of funding of EU bank is good, with 50% of those being basically in cash and reserves at the central bank, which provides a lot of robustness. Now, if I may go to the next slide, and I'm conscious of time, I'm almost finished. There's another area in which we have been focused, shifting now. First, I talked about solvency, then liquidity. Now I'm shifting completely gears within vulnerabilities and risk to a completely different area of risk, which is cyber and operational risk, which pose challenges to banks. And here, if I may, we've been focusing on this area very, very intensively over the last few years, particularly much more intense after the geopolitical tensions. First, we were concerned about operational resilience in the context of everybody shutting down, moving to teleworking when we're going through COVID. Then we're concerned about cyber attacks and cyber risk more linked to geopolitical tensions. Fortunately, none of that did materialize over the last 3 years. There hasn't been any significant disruptions, but nevertheless, when we think about our risk map, this remains a large part of our risk component. Broader than the cyber risk, there's also the operational risk, particularly when issues on fraud, anti-money laundering, sanctions compliance in the context of geopolitical tensions in which we are implementing, and of course more structural issues are related to dependency from third-party providers. As you know, we have the piece of legislation in the European Union that's called DORA, Digital Operational Resilience, in which we are now in the process of implementing to try to assure that this operational resilience around the world, around the system. But I would say more broadly, the digital transformation and the investments in technology that the industry is doing, the degree of competition, is putting operational risk and operational challenge at the core of many of the EU banks, and that's an area in which we need to enhance our capabilities to manage them and to assess them. So if I may, going to the last slide, just to draw some conclusions, I would say that on average, European banks have ample liquidity and capital buffers to regulate Standard & Poor's. This is very good, but I think is an important role for prudential regulation, particularly for supervisors to ensure financial stability. So there is no room for complacency, and I think both banks, obviously as first line of defense, but also supervisors should remain very vigilant in that point. I think that the recent turmoil of the last 2 or 3 months and the episodes of interventions that we have seen has led to rising uncertainty and have changed, as Joe said, the market perception of banks. I think there's a certain degree of anxiety among the stakeholders and a certain degree of trying to identify where the next weak link may be. And that's an area in which we need to be very, very, very vigilant. That's why appropriate, adequate risk management is essential. Having a diversified funding sources for banks is very important, so the liquidity risk is less small. And as I said before, and I conclude with that, our currently ongoing stress test exercise hopefully will provide some additional information, additional light in the status of banks with large amounts of disclosure at the individual level that will help both the stakeholders, but more importantly, the banks and the supervisors to assess their best path going forward in terms of the sustainability of their business model, their weaknesses to the new environment, and how to manage them. So let me stop here. Thank you very much again for the invitation, and I look forward to our conversation afterwards. Thanks.
I hope that you can see my screen and that you can hear me well. So I think that my presentation is going to be very complementary to the one of Mr. Campa. Of course, I'm an insider to some extent of the Belgian banking sector, but also looking with a very critical perspective on the recent evolution of the banking world, and especially with the small crisis that appeared in March in the US banks. I think that this will shed some light on the kind of topic that I'm going to develop. Very briefly on the agenda that I propose, I would like to revert back a little bit to the recent history, the last 10 years or 15 years regarding the bank's business models and priorities, because this explains why the recent economic challenges may have shifted a little bit the profile of banks, and especially their way to tackle risks. If you realized what I have put on my title, there's a kind of oxymoron, because we talk about uncertainty management, but you can't manage uncertainty, and this is a little bit the story that I would like to tell you today. The first element that I would like to describe a little bit, because that explains a lot of things that we are actually currently experiencing, is the evolution of the net interest margin in the banking sector in Europe over the last 10 years before the sudden rise of interest rates. The curves that you see there and the areas that you see there correspond respectively for the blue one to the average margin on loans that banks have obtained on their activities. So the difference between what they charge on loans and the funding cost of these loans. And the gray areas correspond to the evolution over time of the margin on deposits. So the difference between the remuneration that banks give on their deposits on general, so on their liabilities, and the opportunity income that they would generate from these funding sources. And what you see is that with the decrease in interest rates over time, banks have seen, on the one hand, if you look at the blue area, an increase in their margin on loans, which was actually the consequence of a squeeze in their margin on deposits because of the interest rate policy, notably. Interest rates on deposits are mostly driven by short-term interest rate movements, and therefore by the ECB policy. And especially in dark gray, since the crisis of 2009, you can see that this margin has actually been negative. Why negative? Because interest rates being very low, banks were forced to some extent to still remunerate their deposits, and especially the regulated deposits, so the retail deposits at a decent rate, even with a floor that was imposed by a number of governments to 0 or to 0.11%, for instance, in Belgium. And this is the reason why not only most of the effort to obtain profitability was put on the loans, but also globally speaking, interest rate transformation activities, which is the core of the activity of a bank normally, and became less and less profitable. And Mr. Campa showed that the return on equity has increased relatively recently. This is also definitely because of the increase in interest rates, which is good for the interest margin, especially the margin on deposits, but because also of a shift that banks have seen in terms of their business models. And it was triggered by necessity to obtain decent profitability, but also because there was a kind of stimulus coming from the regulatory authorities. So what we can basically say is that the net interest margin has been under pressure for many years, had been under pressure for many years in the so-called low for long environment. And because of that, I think that the current situation that we're experiencing can be partly explained by two phenomena that took place regarding the change in the banking strategies. The first one is the tendency of banks to increase the conventional duration of their liabilities in order to under-hedge their interest risk on the asset side. And as Mr. Campa showed, you see that an increase in interest rates triggers simultaneously an increase in the profitability from the interest rate transformation operations, so the NII, and simultaneously a decrease in the economic value of equity. This is partly explained by the fact that banks have been a little bit trying to protect their margins in a low for long environment, and many banks did not expect interest rates to rise that fastly recently. Therefore, they remained perhaps a little bit under-hedged, and that, of course, the most extreme case was the case of SVB, because they didn't hedge anything at all, if I may say, on their portfolio of bonds. But to some extent, this is one thing that has made banks a little bit more fragile in the current context. The second shift in business model is the fact that banks tended to increase their so-called off-balance sheet activities, which are activities that do not involve a transformation of their balance sheet. And especially there are two of them which are under the scope. Payments, well, this is probably less of interest nowadays, but also asset management, in order to diversify their source of income, respond to the need to obtain a greater return on equity, and also have lower capital intensity, so activate less equity capital in order to sustain their activities, because these activities do not generate a need for Tier 1 capital that is as strong as for the lending activity, which involves the balance sheet. And I have made a small computation showing what had been between 2016 2020 the evolution of the on-balance versus off-balance source of income for the four largest Belgian banks, and it stands clear that there has been a tendency, I have witnessed it myself, to make sure that there would be a better diversified source of income. But at the same time, you know, this opens up a new set of risks for which the degree of maturity in the banking sector is probably less pronounced than the degree of maturity that we have in the management of interest rate risk. Managing interest rate risk has been the core business, together with credit risk management, of banks for decades, while, of course, only specialized banks, which are in the asset management or the private banking business, for instance, would be more in line with the challenges posed by equity capital markets, which is at the core of asset management activities. So that's basically the starting point where we ended up in 2001, 2021, 2022. But as you know, there have been two big events, and Mr. Campa has talked about them as well. I'm not going to be very long on this slide. We have the COVID pandemic, we have the war in Ukraine, which triggered an energy crisis. In terms of the impact of the economy, we had a lot of fear, and this was a very anxiogene type of environment, but the impact was relatively large but contained thanks to a sudden increase and sharp reaction of public authorities. Also, the impact on banks, and I think that the diagnosis that Mr. Campa has done on the situation of the banking sector in Europe is very clear on that aspect. Banks had been part of the solution for both crises, actually, and today we can say that the banking sector, I wouldn't say is stronger than ever, but certainly has shown a certain resilience, a certain capacity to rebound, to protect the economy, and to remain at the same time solvent and liquid. So this is basically where we are. These two crises, which were very large shocks, which were unexpected, totally unexpected, indeed did not trigger much change from a structural point of view. And still, now we have a game changer. And I believe that if I have to express this game changer, I would call it the inflation environment cocktail. Why inflation environment? Well, inflation is a phenomenon that we have witnessed numerous times in history. The problem of this inflation environment is that it's renewed, if I may say so. Well, we know what are the causes of this inflation. We don't know where it's going, when it's going to end. But we also know what are the consequences, and especially on interest rates, and in particular on short-term interest rates, because these are really at the heart of the monetary policy, and of course the decisions taken by the central banks really have the most important impact on the short end of the yield curve. If you look at the right graph here, you see that looking at the changes in the policy interest rate from the ECB, we have been really in low for long environment. And actually it started immediately after the global financial crisis. There has been a small rebound around the sovereign crisis, as you may remember. But we have been living during 13 years in a situation in which there was no inflation. Actually, we were looking forward to having inflation, and interest rates were kept at a very low level. And then suddenly, probably more suddenly than ever, or at least in the history of the ECB, interest rates have been rising to much higher levels, at least in relative terms. What does it mean? It means that basically there are very few people who are active now, and especially in risk management areas, who are the operational people in risk management, who have known the period of high inflation. Actually, inflation is something that we have forgotten. High interest rates is something that we have forgotten. Today we are 3%. Perhaps we're going to be in a few minutes, we're going to be at 3.5% or 3.25%. What does it mean? Indeed, it means that interest rates remain low from historical perspective, but still they are perceived to be extremely high. And when you look at the real interest rates, they are still negative nowadays. So this is something that is unusual, because we are no more experienced with this situation. So that's for me, the first game changer really in the current economy. The second game changer, it's more a long shot, but this is something that is really important. Many people have been aware of the urgency of making changes, making a fast transition to a greener economy and to preserve the climate. We have now a horizon which is 2050 more or less, but we have to move very fastly right now in order to reach this horizon, in order not to enter in this failed transition situation in which we would be too late. We would have too small action, and there would be big depredations in the economy, especially because of major events that would actually damage a lot, not only the economy, but the whole society. Banks are perceived as a major actor in the transition. This is logical, because banks have the power of leverage, have the power to allocate resources in the economy like no other actor has. And banks have been put pressure on in order to speed up the process, there have been these last year the climate stress test showing also that there was a large under preparation to gather data to make scenarios regarding the way transition would take place. And even though lots of people were aware of the challenge, now this challenge has become pervasive in the economy, pervasive in the society, and there's a demand by customers, by stakeholders, that indeed the financial sector takes its fair share of the burden. Inflation environment altogether is something that needs an adequate response regarding the way risks are going to be managed within the banking environment. And actually, my thought is that we're no more into the traditional risk management framework as we know it, as people like me teach it, in which basically when we talk about risk management, we talk about something that is relatively comfortable. If you look at this chart, you see that when we talk about risk management, we talk about risk, and when we talk about risk, we talk about something that are called known unknowns. What is a known known? This is something that is deterministic. This is easy. We know exactly how to handle it. A known unknown is something that we don't know, but we can basically model. We can associate probability distributions to it. We can associate scenarios to it, which are fairly well educated, fairly well known. Only what we don't know is what is going to be the outcome of a certain event, and we can take action in order to mitigate the impact of these outcomes. This is how risk management has always been thought of in the economy. Today we are moving into something that I would call the unknown unknowns, and the way to handle unknown unknowns is much more difficult because it involves creativity, it involves thinking out of the box, it involves using no data or less data. And my conviction today is that we have entered a world in which the risk profile of banks is mostly turned towards managing uncertainty and dealing more precisely with uncertainty, rather than trying to improve or to deepen our risk management framework as it is now. So I would summarize it like this. While the Basel framework, as we know it, has always been built around the notion of risk management and the mitigation of these risks, even the solvency requirements in Pillar 1 are based on a measure of risk which is based on a modeling situation. I know that there's a debate about whether models should be used in some areas, for instance, for operational risk in order to obtain capital. And these models must be fed with data and with parameters. Data means we need to have a certain history on which we can build some inference, some numerical simulations or whatever statistical approach in order to deal with the data. And the parameters are just the way we are going to obtain the sensitivity of the outputs to the data that we put as inputs. And the outcome of the model tells us how we are going to deal with the risk, what are going to be the actions that we can take in order to deal with this risk. And we know in risk management that there are basically four causes of action. We can try to avoid the risk because it's too high and there's no way we can deal with it, transfer it, mitigate it, or keep it, that is, accept the risk. There are many things, I think, there are many areas in which we have turned towards a world in which such a very comfortable course of action is not adequate anymore. And I will take four of them, if you don't mind, for the remainder of my intervention. The first one is whatever is dealing with the off-balance sheet activities of the bank. This is nice to diversify the sources of income because obviously for instance, the changes in interest rates might not have such a big impact on the behavior of clients in private banking or asset management than it would have on the loans booked at amortized cost, for instance. Nevertheless, the problem is that the banking world is not ready, and especially the supervisory world is not ready to deal with this issue. Stock market risk is a risk that today can be hedged by tools that we know, swaps or financial futures, but actually banks cannot hedge this risk. It's as if you were dealing with a government that withdraw taxes on the basis of capital gains on the stock market. So there's a lot of debate about taxing the capital gains. The problem, of course, is that the amount of taxes is perfectly correlated with the evolution of the stock market. Stock market goes up, people make lots of capital gains, you get more taxes. Would you accept that the government has most of its tax bill based on the evolution of your stock 50? This is a real challenge, I think, and this is exactly what happens in the banking world. There's an argument that says yes, but there's a diversification argument. The source of income that you obtain from off-balance sheet activities has negative correlation with the source of income that you obtain from the on-balance sheet activities, that is the banking book and the evolution of the transformation activities. It's not always the case. In 2022, the stock-bond correlation was highly positive, even though conventional wisdom would say that it would be normally negative. So this is something for which we have to be extremely careful for the future. Diversification is one thing, but dealing with the risks involved with diversification is also a very important concern that we have to deal with. The second one, and I know that I'm going to fuel the debate about that, is the liability, so the funding source of banks. Mr. Campa has elaborated on the fact that banks have a diversified set of funding sources, and definitely, of course, deposits from households is one of the major ones. In Belgium, this is a very important one. We know that because there's a lot of savings. And as you know, there's a question about whether banks are generous enough regarding the tarification of the deposit accounts. You see in this table what happened in December after the first wave of increase in the remuneration of regulated saving accounts, which is obviously still much lower than what you see in terms of the short-term interest rates set by the central bank. We are more than 2% away for the largest banks between the gap between the market interest rate and the remuneration of deposits. Why is it so? Is it because banks are greedy, because it's a cartel? No, there's a much more fundamental reason to that. Banks don't know what is going to be the supply price elasticity of deposits. Indeed, the models that were calibrated on that ground are too old. And the data that banks dispose of in order to model the behavior of their customers are simply absent. So we are in a world in which basically the evolution of interest rates is such that there's not enough history in order to implement and to roll out a model in order to say this is the moment at which I have to increase my interest rate on savings accounts because the gap between market and deposit interest rates becomes too large. We have models. The models, we are not sure that they work. Plus, you add the uncertainty that was created by the recent crisis with the American banks and the Credit Suisse, and it is clear that it is much more a matter of managing uncertainty rather than using models. You can expect, of course, that the situation is going to normalize at some point. But this is clearly a problem for banks to find the right balance between bonds that they issue, so midterm bonds, between their term accounts, savings accounts, finding the right mix, know what are the flows that go from one to the other, from one bank to another. For the time being, I can tell you that this is still something that is very mysterious because simply we lack experience. And indeed, this is not only about inflation, this is not only about interest rates, this is also about this phenomenon of climate risk and ESG policies. Let me discuss a little bit something that happens on the asset management side and the market risk that is triggered on the asset management side. As I said, lots of people have been aware of the ESG challenges that are ahead of us, but the real burst of the global approval of these notions and the fact that lots of people, if not everyone now, is aware in Europe that we need to take immediate action, this is relatively recent. And what do we know about that? We know that in finance, and especially in asset management, if you restrict, if you narrow the universe of assets in which you can invest, you lose a diversification premium. This is not something that we have witnessed for ESG investments. If you look at the left graph, you see that the evolution of the cumulative return of an ESG excellent investment in blue has been significantly better over time than non-ESG investment. This is perfectly explainable by the fact that lots of people and the majority of investors were simply not aware that ESG excellent firms were actually outperforming non-ESG excellent firms. Now that we are all aware that this is necessary to become excellent from this climate perspective, it is also clear that we are probably moving to an environment that's going to be a bit different, and the voluntary restriction of the investment possibilities at the level of portfolios will actually more than likely result in a negative premium. And of course, this is also something that is important for banks. This is important for insurance companies or pension funds that impose themselves very strict criteria regarding ESG. And at the end of the day, this is also important for clients. So again, from a risk management perspective, you have to manage expectations and you have to make sure that there's a balance between the financial and the non-financial risks that you take when you decide to invest in ESG excellent companies, so the ones with a higher than average ESG score. And I don't want to enter the debate about what is the quality of ESG scores. We know that the market is still not mature for the time being. And finally, the fourth aspect that I would like to discuss, and I think this is also in line with a remark that Mr. Campa did on the commercial real estate, is the transition risk. Well, this is broader than real estate, certainly. We know that we are in a situation today, if we take the picture, in which there has been systematically over the last years, including the year of the pandemic and including the year of the energy crisis, a lower than expected number of defaults in portfolios. And what did banks do? That banks took provisions. We have talked about the stage 1, stage 2, and even stage 3 provisions. Let's simply look at the stage 2. The provisioning for stage 2 loans, so loans that are not yet impaired, but that are in the danger that have a substantial risk of being impaired. These provisions have been totally erratic in the banking world, from one bank to another, from one quarter to another over the last few years. Why? Because we have too few defaults. Of course, I should be very happy to have too few defaults. It also means that we have too few data points. In order to obtain good credit risk models, you need to have a probability of default that is a fair estimate of the actual likelihood of default, and we have to have loss given defaults which correspond to the real loss that you have in case of default events. Not only we don't have enough data in order to make faithful models, but even if we had enough data, the data would be worthless in front of what we are expecting to see in the transition phase to a greener economy. This is going to take time, but it's already starting today. There's going to be a significant cost and significant effort to be made in order to carry this transition. And this chart that you can see is an illustration of the size of the challenge that we have. This is a map of Paris, and the color codes and the figures correspond to the percentage of real estate properties in each of the arrondissements which have an EPC that is worse than EFO, that is equal to E, F, or G, that is in the worst categories. What do we know? We know that by 2050, the whole map should be white. The whole map should be such that real estate properties should have an EPC of A or B. What does it mean? It means that basically every single building in a city like Paris has to be completely refurbished in order to make it compliant. Who is going to pay the cost? Who's going to have the burden? Well, the people typically who have the lowest possibility to repay the loan are also the ones who have the worst energy consumption and the worst energy performance in their property. So clearly there's going to be a number of defaults, not only at the level of commercial real estate, but also at the number of borrowers in their mortgage loans. There's going to be also a number of companies that are going to suffer from that. And we have no clue of who's going to be, because we have not gathered enough data yet in order to understand what is the nature of their problem and the extent of their effort in order to do so. So my last slide and my conclusion is the following. I'm very glad, and as a citizen, I'm really pleased to see and to have confirmation by the EBA that the European banking sector has been considerably strengthened, both on their liquidity and their solvency, but also, and that's more recent, with their profitability. Banks are really part of the solution, no more the real problem as it used to be the case in 2008. But this new normal world is quite, well, triggers a lot of anxiety with respect to what is exactly expecting from the risk behavior of these banks. I think the old recipes are no more useful. Models have their merits, but they also have their limits. The problem is that we have to cope with uncertainty. We cannot avoid it anymore. This paradigm shift means that we should put much more effort in out-of-the-box thinking approaches like scenario-based, like stress testing, and I'm very thankful for the EBA of being strict and being tough on the stress test that it imposed on banks, and also a mindset which is think the unthinkable. And I would like to finish by saying that what I have stated regarding financial risk, because this was most of the scope of my presentation, is also valid for non-financial risk. And Mr. Campa talked about cyber risk, which are at the forefront of our concerns, but also human risk. We know that there's a significant risk of having the wrong resources, not having the right resources in order to take the challenges. And also other financial activities. We know, for instance, that for insurance, and especially casualty insurance, we are in front of a major problem regarding the insurability of a number of properties, not only non-insurable by insurers themselves, but in which the reinsurers are simply not willing to provide a quote in order to have this insurance. What will we do with that? How it will affect the capacity of repayment of the owners? There are a number of challenges that I think are open before us. This is very challenging, and this is very exciting for a researcher. For a banker, this is probably a little bit less exciting. Well, thank you for your attention.
Thanks to both of you, José Manuel and Georges, for this very comprehensive overview on the risk profile and risk position of the banking sector, and this brought into also a broader perspective, very insightful, and as said, a complementary one compared to the other. Also thanks to have been disciplined so that we have still some time for questions, and I notice also that the director of a bank is pleased with the stress testing of EBA. That is well noted as well.
Independent director, I'm not executive.
Okay, we received a couple of questions. First question is a more broader perspective. Given the turmoil we have seen in recent weeks in the financial sector, and it's addressed to both of you, what would be your recommendation to the European legislator who is debating and who would like to conclude the debate on Basel III in the EU? You heard, in fact, two possible way forwards. On the one hand, those that said Europe proved to be more robust than the US, so we should maybe not exaggerate. We are more or less at the right level. Or others that are saying this is a wake-up call for all of us. The US has certainly a problem with the scope of application and the scope that is applied of the Basel framework to its banks. It's only limited to international, very big international active banks. But in Europe, we should also be quite vigilant on that. What is your opinion? Maybe first José Manuel and then George on that point.
Yeah, thank you. Thank you for the question, Joe, because I think it's also timely. As you said, it's always debate going on and the local legislators and in the latest stages. And for me, it's quite clear, you know. First of all, the reform that's in place is finalizing the implementation of Basel III. So it's not like a new reform. It's an added part of a broader reform that has put forward since the global financial crisis. And when we think about broadly, what has brought those reforms of Basel III is clearly positive. You know, I think that the banks now are better capitalized, more liquidity, more robust in the risk management, better governed. And I think that finalizing that implementation and sort of putting, if I might say, you know, a stop on the work that needed to be done and then thinking forward about all the things that may be done, it's important. So for me, a timely implementation of Basel III has already been reinforced by the events that we'll see. As you said, some of the not so small but regional banks in the United States, you know, were subject to somewhat lower liquidity requirements, reporting requirements, IRBB analysis that were part of Basel III. But of course, the Basel is implemented for large global banks, and the assessment of the US at the time that these banks were not large systemic banks, so they don't need to enforce that. I think the fact that in Europe we've been imposing those rules to a larger set of banks so far, at least, has proven us to be in a more stronger position. So for me, full implementation as soon as possible is the best way forward.
George?
I think that the European banking world is more solid also because the notion of systemic bank is broader. You see that in US, two banks which would have been systemic, domestically systemic, but still systemic and therefore heavily watched over their shoulder by the authorities. Two of these banks were basically much less under supervision and regulated than European banks. So the first issue that I would consider would be probably to even reinforce the regulation supervision to all banks that could have an impact on the by a spillover effect on the economy. In Belgium, in Europe, I don't think that there are many banks that are at the same time large and non-systemic. So I believe this is not a really an issue. The second point, I think that threats in Europe come from the outside, if I may say so. If you see what happened to Deutsche Bank, for instance, well, I wouldn't say that it was business as usual inside the bank, but most of the anxiety came from actions that took place on financial markets. So there are a number of low-hanging fruits that I would see back in the front of the agenda. For instance, for listed banks, the possibility of short selling. This is something that may be detrimental to a number of banks. It should really be traced and should be severely, or at least strictly framed. And secondly, the use of CDS market. I think that still, we know that it was a problem for Greece in 2011, and this is something for which we have also to be stricter on the application of transparency rules and market manipulation mechanisms.
Thanks to both of you. Maybe two questions still, if you have time for that. First question is on interest rate risk. George, you mentioned that it is really crucial part of risk management framework for years, and especially in Belgium, given the some specificities of the saving markets. But still, interest rate risk is still a Pillar 2 treatment in the Basel framework. It is not part of Pillar 1 requirements. Should we not reflect or reconsider this? If we can have operational risk in Pillar 1, why should we not have a basic risk as interest rate risk, and as this is as crucial as we have seen also in the Silicon Valley case, where there was lack of proper interest rate risk management. What is your opinion on that? First, George, and then José Manuel.
I would tend to agree with this suggestion. We have, the story of Basel, if I may, you know it better than me, both of you. But the story of Basel is a story of reactions to shocks that have been observed in the economy. And here, just like operational risk was, the main priority of Basel II, and solvency liquidity priority in Basel III, perhaps the recent crisis shows us that we have not paid enough attention to the management of interest rate risk, which is a complex risk because it plays both ways. You have the risk of decaying interest rates on the value of equity, the risk of increasing interest rates on value of equity, decaying interest rates on your profitability, and you have to find the right balance between the two. And I think this is something that we have to pay renewed attention upon.
If I may quickly, Joe, from my side.
Yes.
I have the impression that clearly IRBB, interest rate risk in the banking book, is becoming more prevalent, and we need to be paying attention. I mean, we know, and Joe, you know this very well because you're part of our board of supervisors at the EBA. We've been paying a lot of attention to this over the last year and focusing on it very intensively. I think as we go forward, that must continue. I think Basel needs to reflect first on how countries have applied the Pillar 2 requirement, how they've been using it, and towards them, because some of the evidence that comes from the US, as we're discussing, is that there were serious weaknesses in the management by the banks of this risk, and then on the supervisory surveillance of that management. So I think that needs to be addressed and try to identify best practices. On top of that, if I may, and I don't know, maybe I'm jumping to a different topic, but I very much like the presentation by George Hofner, and I think that in this area, but in many other areas, we need to be conscious that we're moving to a world that's different from the world where we were, from low interest rates to high interest rates. And after 10 years of changing interest rates, the world has changed a lot. So we cannot use the past to predict the future. And we need to think up very seriously about, can we just continue to calibrating our risk models based on past experience, rather than moving forward into more scenario-based and simulation exercises, which I fully agree with him. For this area, for instance, when we think about models for duration of sight deposits in banks, we need to reflect about not about using past experience, but think about more about modeling future dynamics. Same thing with ESG risk. I fully agree that we need to think about more scenario-based assessments rather than historical evidence.
Thanks. A last question, and I think we can discuss this for the rest of the afternoon, but that's not the objective. It was a question raised by Professor Rudy van der Vennet from the University of Ghent, well known to this audience as well, who raised the issue of cross-border consolidation, very topical for years now. By the way, Professor van der Vennet was in the early days of the EBA member of the stakeholders group, so he is familiar with the environment. He is arguing that we should have more cross-border consolidation in Europe in order to compete with US investment banks. You see that not everyone in Belgium is thinking the same on this issue, as you know. There is, of course, the risk of too big to fail, but we see that in Europe there are still some barriers, so-called impediments. Which one do you identify as crucial in that debate? So two things. First, Do you agree with Professor van der Vennet that we need more cross-border consolidation in Europe to compete US investment banks, or are there too much drawbacks on that? And secondly, if we need more cross-border consolidation, which barriers should be considered or reconsidered? I know it's for hours, but please, each of you in a couple of minutes, maybe start with George and then José Manuel.
Yeah, so Rudy is my colleague at Delphis, so I have to be cautious. I believe that the too big to fail issue is not so much an issue anymore, if I may say, because that is becoming a virtuous, or at least much more virtuous than it used to be in the past. So we have a very fragmented landscape in Europe, and I agree with Rudy that this is clearly hindering a number of advances that we could make in terms of service to the clientele, for instance. And actually the fear of being too big is, for me, less pregnant than it was before, because actually being big means that you very heavily watched, that you have a very strong set of constraints that actually make the bank more solid. So we're not in the world of pre-2008, in which indeed trying to have the largest size bank was actually a dangerous move. And since we are so fragmented, I think there's scope for indeed cross-border activities. But I know that José Manuel has done much research on M&A activities in his past life, so he's probably knowledgeable in this area.
Thanks, that's my past life. But if I may, I think that if I may broaden the question, I think, because for me, consolidation, what is cross-border, it should be an outcome, not an underlying reason, But for me, what's very important is that we should have more cross-border diversification and deepening of the banking and the single market, the European Union, that we currently do. It's part of the paradox that we have built integrated supervision. We have built a single rule book. We almost, to a high degree for large banks, we have integrated resolution. And at the same time, the degree of cross-border banking activity, not just consolidation, but banking activity and cross-border holdings by banks has not increased. On the contrary, has declined over the last decade. That's a paradox. And I think the goal was precisely the opposite. There will be more cross-border banking. At the same time, we know that the issues about profitability and sustainability business models for a certain number of banks, particularly in the new interest rate environment in the European Union. So I think that should bring an opportunity for good banks to excel and not good banks to orderly exit the market. And for me, that's more important. But that at the end ends up happening as well with a deepening cross-border market and more cross-border consolidation. Well, that's the better, because that really means that we have a cross-border single market in the European Union. Now, how can we achieve that? I think the reform of the CMDI that has been put forward by the Commission is a step forward, because it facilitates, I think, the resolution of mid-sized and maybe less efficient banks going forward. That's good. I think that we also need to continue to think about ways to deepening the market, to make capital more fungible, liquidity more fungible, also to make, the perception of customers of the products being transmitted to them more fungible, And finally, as we know, there's so many other rules that affect banks that remain very local, starting from insolvency laws, labor law, many other issues that also will always remain local. So, as I said, the important is cross-border risk diversification is really what we should target for.
Okay, thank you, and thanks to both of you. I think we have to conclude here. It's 14:20. I would like, first of all, to thank both speakers for their very insightful views and interesting overview of the current state of affairs in the financial sector and the recent trends and risks. Thanks to the audience, and see you on the next occasion. Bye.
Bye-bye. Thank you.
Bye-bye. Thanks.